Welcome to the Nebraska Soybean Board Weekly Market Roundup. It's being brought to you by Nebraska soybean farmers and their checkoff as I broadcast today from the Nebraska Cattlemen's Annual Convention and Trade Show that took place in Kearney. And I made the comment, probably not the best week to be around a bunch of cattlemen when we saw the way the market traded. We're going to look at that, the WASDE, weather in South America, and all the factors that affected the trade on this week. So stick around.
Meet the champions of innovation in the heart of Nebraska. They're not just farmers, and they nurture more than just crops, pushing boundaries and turning challenges into opportunities. They trade knowledge and know-how, and their dedication doesn't end at harvest. It's in your every bite and every drive. The future of food, fuel, and fiber, and the future of Nebraska starts right here.
Well, welcome back. As you can see, we've got Kyle Bumsted joining us and Alan Brugler. And gentlemen, it has definitely been an interesting trading week. And I think at some point, I'm just going to sit back and let you two talk about what we're seeing in these markets. And I do want to start out with this cattle market because I think this was probably one of the most struggle bust weeks I've ever seen in quite some time in the way this cattle market traded. And I give reference to the fact that Thursday, there was a hope and a glimmer. We might have seen some higher numbers and it finished to the lower. So I guess both of you kind of give me your thoughts. Alan, we'll start with you. Kind of give me your thoughts on what you saw at the markets, and then Kyle, jump on in.
Well, I think the key point here is we had a huge run-ups in the last year and a half. You got a lot of fund longs. You got you've got some concerns about the beef market now with the consumer being squeezed. Inflation, interest rates, that whole story that's been played out for a while here. But you are starting to see some weakness in the beef market, and seasonally you would anyway because of Christmas and the turkey and ham demand. But the point is, once the funds started getting out, they were having a hard time getting enough liquidity to do so. The people who've been feeding margin calls for the last year aren't in any hurry to give them their money back. So you've got this downside pressure here. If you look at a daily chart, of course, we're pressing life of contract lows on several of these cattle months, but on the monthly chart, we haven't even gone down to the moving averages or the 18-day or the retracements or anything yet. This is we're still up there from that perspective.
Kyle, what are you seeing as you look at these trade numbers?
That's correct. We are still up there from a monthly perspective and somewhat of a weekly perspective as well when you look at some of the continuous charts. But I do want to emphasize that Thursday you mentioned there was a glimmer of hope, but we went on and made several months out back, made new contract lows, and bull markets don't make new contract lows. And as Alan said, the funds, they were loaded long and the boat just basically got one-sided. Now, some of the things that are concerning was with that box beef demand here right after Thanksgiving. Now, we've had shorter production run that week, which was 2 weeks ago, and we should have saw box beef really start to bounce here last week, or at least get some of that seasonal, because once you get through Thanksgiving, a lot of the turkey is over with, and a lot of consumers are switching to beef for the Christmas holidays. So we didn't see that, and that's a little bit of a concern. And we are at a point where we should be trying to find a bottom in box beef, but I think that choice box might want to go down and check that 268 to 270 level. 275 is going to be an area of support there too. So, until we start to see this box beef market catch itself, we could be on the rocks yet, especially, after the close today, there was rumors, and I know confirmed trades of 168 here in central Nebraska to majors. They're fighting for hook space now. We're out to about the 7th or 8th of January. We're out to the second week of January as far as hook space. So that's what, people are just trying to get a hook right now. The carcass weights are record high, and we're still backing up some cattle out here. Our production runs as far as slaughter have not been the greatest.
Well, it's no surprise that you've got carcass weights high because what amazing growing conditions that we have. There hasn't been a lot of weather stress to add any issues for these cattle.
That's correct. And until we see that happen, we're still going to add some tonnage on this market until we get a weather, or a full out actual weather issue. We just haven't had that.
All right, I'm going to let you two have this next discussion. What are your thoughts on LRP and this cattle market in the current state that we're in?
Well, we had a little offline discussion about this. The real question is, what evidence do you have that the insurance companies are actually the perpetrators here or the main player? We know in crop insurance, the companies don't hedge, or at least nobody's ever said they did. They treat it as an actuarial situation where premium collected minus losses with a little government subsidy thrown in. So we think there is some risk management being done, and that's probably aggravating the slide here. But it's really hard to say that is the smoking gun here. I think people are mistaking that the fact that we've had this huge run up and we're just taking profits and taking money out off the table, and they're trying to find somebody to blame for it. Before we get away from the cattle, and we can throw this back to Kyle, but I do want to point out the other issue is we've got way more heifers on feed here than we expected to have three or 4 months ago. That heifer ratio is over 40%. It's one of the highest we've ever seen. The market was pricing in a much lower cattle supply on feed than what we've got. But the bull side of that means we're also delaying the turn in the cattle cycle. January is going to show us lower herd numbers. And, there's still going to be very tight numbers in 2024.
Kyle, what's your thoughts on the whole LRP chitter chatter? And I heard that here at the Cattlemen's Convention as well.
Well, like Alan said, we can't actually prove that there was anything like that going on as far as where they were spreading the risk off. But I do know that several farmers and several backgrounders got caught because they were talked into selling puts, low volatility. Puts they were selling puts underneath these LRP policies to try to offset that, and they had to run to the futures market here to try to delta themselves off once this thing really started breaking hard. It really brings the lesson, kind of what happened a few years ago in natural gas, so to speak. The volatility in the options was so low, and they said, it's all right, it's no big deal. And then all of a sudden they got caught, and the volatility went from about 8% to about 24-25% here recently. And that's what they've had to do, is they've had to run to the futures and try to sell futures and bail out of their short puts and things like that just to try to cover themselves. But to Alan's point about the heifers on feed, until this interest rate really starts to come down, I think we're going to keep heifers on feed, because of what it's costing out here. People are going to move heifers so they can stop that interest at the bank, and we're still seeing that. And we probably won't see heifer retention start until this interest rate starts to break a little bit.
All right, we got to switch to this WASDE report that came out on a Friday midday. Alan, did you see any surprises in the numbers? And I understand really no changes when it came to soybean information.
Yeah, there really weren't any surprises. You got a little bit of buy the rumor, sell the fact action in the beans. USDA did cut the Brazilian production 2 million tons to 161, but they also raised last year's production by 2 million tons, which meant you had a bigger carry-in to start the year. So net, you didn't really provide any room to raise soybean export estimate. And the crush numbers, some people thought with the record crush we had coming out of the CARE report on the first of the month, maybe they'd raise the crush, but they've already got crush 88 million bushels above last year. I think we need to see some more of these plants come online to really move that needle. Bottom line, they didn't change anything in the beans. On the corn side, we were watching the exports pretty closely. They did raise them a little bit, but again, the world numbers didn't get any looser or any tighter. They were just very close to where they were last month. So, a fairly typical December report, not moving too many numbers, waiting for the January grain stocks report to get more data.
Do you think, Kyle, this report was more of a South American focused report with numbers? Maybe?
As far as South American focus, I'm looking at that March-May bean spread at 14 cents carry and the May-July bean spread at 6 cents carry. Still telling me that the commercials are thinking there's a weather issue down south. There's plenty of carry up front here. We're bearish carry from Jan to March, and the corn situation is the same kind of deal there. We're bearish up front here, and I think a lot of guys are kind of getting a wake-up call here, and they see their tax man and their banker here at the first year. They probably should be moving some corn and probably be moving some beans here, because with what interest rates are and what it's costing here at the bank, you might as well be stopping some interest here instead of welding those bin doors shut. And I think you could see that happen, which you normally do that in a carry year. Boy, hang on, it's going to get better out back there, because it's higher out back than it is up front in the long run. If you don't take advantage of that higher price out in the deferred by protecting it somehow, by either selling the cash out there as far as a cash contract or a put of some sort or a future sale of some sort, that cash price, is usually leaking down to where the front month went off. Case in point, December corn sitting right in the mid 460s and March corn sitting around 485 and a half. And I think that you're going to see March corn get down in the mid 460s here before this thing really gets all said and done here after the first of the year, when March is, close to delivery or getting ready to go into delivery. You're going to see that March contract leak down. Then subsequently in the future, if things keep going like they are, you're going to see those leak down there towards the front months, because they just don't really need a lot of our corn right now. And that's what the market's telling you. We're paying you to store it.
All right, I want to pose this question to both of you guys. As we look at the last couple of weeks of 23 and we get towards 24, what are some things that producers need to be thinking about, grain or livestock, in their marketing plans? And Kyle, I'll start with you.
Well, I think you need to run through your numbers, talk with your lender, talk with your CPA, get your book work done here before the first of the year, because there's still some people that are, worried about tax issues and things like that. So, look at that. Also, don't be afraid to look out there to next year between soybeans and corn. That soybean corn ratio is about 2.48 to 2.5, which favors a few more beans right now. Everyone says, well, there'll be a big acre battle going on for corn in the spring. I don't know if that's necessarily going to be the case, unless that was like at a 2.6 or 7 like that. I don't necessarily see this being an issue right now. In fact, they're probably buying acres right now. A lot of fertilizers getting applied right now, and a lot of those decisions for next year's crop are already been made. They don't get made in March. They get made in September, October the previous year.
All right, Alan, for you.
Well, Kyle's point's well taken. The interest rates have changed the math a little bit. Storage costs you more per month per bushel at this price level and this interest rate level. It doesn't mean you can't make plenty storing grain. Obviously, storage hedges can work. We briefly had full carry on the March-December spread for one day here just recently, and then of course the market reacted to that, because at full carry you don't sell nearby cash corn. You just hedge it or forward contracted for later. I would point out that the basis, corn basis, national average basis, has improved 24 cents since the 1st of October. That's a pretty good improvement. It's fairly typical from a harvest to December. We do tend to earn carry against the March, but we don't tend to earn carry, at least in recent years, from March to May. And that's partly a South American influence, I think. So, something to think about as you're storing grain. We would also point out that farmers are undersold on corn, we think. Commitment traders suggest the elevators don't own a lot of corn. We've done some recent work on this. It does not necessarily mean you're going to get a big rally or a big sell-off. Okay, out of 6 years with similar undersold scenarios, 2 of them we got a nice rally, and 2 of them we didn't, and 2 of them was kind of wandering around. So you can't count on that being undersold doing much for the market here.
All right. Well, thank you both for joining us this week. We always want to remind you, commodity futures and options do involve a substantial risk of loss, not suitable to all investors. And that's the Nebraska Soybean Board Weekly Market Roundup.